this is Rob Rendell with Feedzai, here to give you your weekly update. Two topics I want to talk about today are the recent announcements by the Consumer Financial Protection Bureau with relation to scams and the reimbursement policies that financial institutions have to follow, as well as the potential economic downturn and lessons learned from 2008 and its recession. So first, the CFPB recently announced that financial institutions may have to start reimbursing for fraud losses related to scams. Today, here in the United States, financial institutions aren't forced to reimburse for consumers that fall victim to a scam and send the funds to a fraudster. Financial institutions typically try to recover the losses and reimburse if they are successful. When looking at our counterparts in the UK banks are forced to reimburse for these losses. Fraud management here in the United States need to start thinking about the total number of instances and total dollars that their FIs are facing and their customers are facing related to scams, and make sure they have line of sight to this vital reporting in the event the CFPB starts forcing financial institutions to reimburse for these scam losses. Fraud plans will likely have to double, as if we look at our peers in the UK, scams outpace account takeover for the first time last year. With the looming economic downturn, we might want to take a look at lessons learned from 2008. If we look at how we've progressed in 14 years, fraud has significantly advanced. It has scaled and it has actually turned into a fraud as a service with organized fraud rings. Major issues back in 2008 were scams, card-not-present fraud, online attacks, and account takeover. In recent years, card-not-present has significantly increased as consumers have adopted transactions in the digital channels. Additionally, consumers have adopted more online and mobile banking, and we're seeing a rise in mobile malwares. Financial institutions need to be looking at their practices around validating transaction activity from not only a fraud standpoint, but also a scam standpoint, ensuring that agents, when speaking to the end user or consumer, are looking at whether or not the customer was a victim of fraud or being victimized by the fraudster and sending the money themselves. This is Rob Rendell with the Weekly Update.